It's a wrap on Q3 results season, and who better to break down the good, the bad and the ugly of how corporate India has turned out in Q3 than Gautam Duggad, Head of Research, Motilal Oswal Institutional Equities. His quarterly report, in fact, is one that the market watches very keenly. Gautam, hi, great to have you on NDTV Profit. This was an important quarter because it was, in a sense, the quarter of reckoning after the kind of run-up and slightly insane run-up we saw towards the end of calendar year 23. Then the question became that have these companies really performed? And that's what Q3 was all about. In that context, how many companies do you think have stood that test?
Hi, Tamanna. Good morning. Thanks for having me here. Yes, you put it quite correctly that markets has had a fabulous run, and therefore corporate earnings to that extent becomes a very important driver and indicator to track. I think this quarter has gone off quite well aggregate basis. If I look at a very top-down view for the 250 odd companies for which we predicted earnings in our coverage universe, we were predicting an earnings growth of 19%. We've got 29%. So decent beat. For Nifty, we were predicting about 10% earnings growth. We got 17%, right? More importantly, a lot of sectors have contributed, auto, which has beaten expectations big time, PSU banks, they've also beaten expectations, cement, even private banks at about 20% plus earnings growth have met our expectations. Metals and oil and gas have been a big driver. Obviously, metals on a very low base, and given the nature of the sector, the beat was quite humongous. We were expecting 20-odd% kind of a growth in metals. We saw 70% plus. Even oil and gas led by OMCs have had a very strong quarter. The only weak point that I see in the quarterly earnings was consumer, more so on the staple side and the low ticket consumption item, which is going through a period of lull. So top line growth was very muted, even though earnings overall at about 14% profit growth was better than our expectations. And then, of course, tech. While expectations were muted and those muted expectations were met, the commentary still doesn't point towards any big revival in the offering in tech. I forgot to mention even pharma earnings were quite strong, and we have seen earnings upgrade in pharma. So all in all, a pretty good earnings season. We are well on track to deliver 20% earnings growth for FY24 for Nifty. We had started with an EPS of 975 for the quarter for FY24. When we ended the quarter, we are still at 976. So that basically means 20% earnings growth for FY24. And we are at about 1140 rupees for FY25 Nifty EPS, which basically converts to about 15-16% growth. So if that happens, we've already seen a 22% earnings compounding for Nifty in the last 4 years between FY20 and 24. And next 2 years, 24 to 26 also is looking quite decent at about 15-16% growth. So corporate earnings are quite resilient and completes the very strong macro and micro picture beautifully.
Yeah, and also underlines that despite valuations that have run up, there is a solid reason to bet on the growth of these companies. But you talked about metals being outperformers. I think auto has also done very well and surprised on the upside this quarter. What about your public sector companies? And I come to that because the kind of run up we saw, and it's a wide basket, so we'll get into the details, but railway stocks, solar energy, power, defense, all of these, a lot of companies running up because they're owned by the government and were seen to benefit from the kind of capex push that policy-wise has been coming in. The question is that on margins, on deliverables, on speed, on efficiency, did they really pass the test?
So, Tamanna, before you look at the PSU, you also look at what happened in the previous 10 years. If you look at the BSE PSU index in CY12, and CY21, they were virtually flattish. The PSU as a pack, the earnings, I remember we had put out a note in December 22 when we analyzed the decadal performance of PSU companies, both earnings, market cap, broke it into two halves and all of that. The earnings were also very lackluster. Now, between December 22 and now, the PSU index has done fabulously well. Large part of the incremental push on earnings as far as fundamentals are concerned has come from PSU banks. PSU banks were making losses till FY18. After that, they started improving. And now they are at such a scale that they are doing phenomenal profit numbers with 20% ROEs. Who would have imagined SBI will do 20% ROE? 4 years back, if you'd asked and taken a poll, not many people would have said that, right? So PSU banks have been a blockbuster set of earnings once again. In fact, this is the first quarter where I have seen that PSU banks have outperformed private banks on earnings as well, right? We have seen upgrades in earnings for PSU bank while marginal downgrade in private sector banks. By PSU banks aside, the other element of the PSU's basket, things like OMCs, oil and gas companies like GAIL, and some of the mining names like Coal India, NMDC, they posted very solid set of numbers. Yes, on railways, some of the defense name, there was some disappointment in earnings are concerned, and which is why you've seen a very quick market reaction coming in there as well. But unfortunately, we don't cover that segment yet, especially railways and defense. So I'll restrict my comments on what we cover, which is metals, oil and gas, and PSU banks. In fact, in our own model portfolio, we had increased the weight of some of the PSU names. We've been having a significant overweight on PSU banks since 2022. In fact, we are underweight on private banks for more than a year now, and we have almost 400 basis point of an overweight on PSU banks, which we continue. Because even after such a significant run-up, the PSU banks are still trading at about 0.9 to 1.1, 1.2 times price to book, when their ROEs are doing about 17, 18% consistently for last year, this year. And our expectation is this ROEs can sustain for next 2 years. So yes, the PSU index has done phenomenally well. One element responsible for that is also underlying corporate earnings. And second, obviously, the expectations of political continuity, and therefore the hope that the policy momentum will continue to remain intact, and the way the government has prioritized capex in the last 4 years, where we have seen the budgeted capex going up from 2.5 trillion 5 years back to almost 11 trillion now. I think that push, the fact that political continuity, that perception is getting bolstered, that augurs quite well. Yes, some of the stocks obviously are looking overheated given where they were trading at 1 year back and where they are. So there will be a disappointment if the earnings
Top
don't follow
lemons.
this.
Gautam, let's be specific. What would be the top lemons in terms of overheated, stock runs that have not actually proven their point or lived up to those expectations in terms of quarterly numbers in Q3? What would be your top 5 lemons? And let me expand it beyond PSUs.
So in so far as PSU is concerned, as I said, for the sectors that we cover in PSUs, which is PSU banks, oil and gas, metals,
they all
and mining,
did well. Yeah.
Numbers were quite well, which is why we still have GAIL, Coal India, HPCL in our model portfolio, SBI and Bob I mentioned. Sectors which I said disappointed are consumer staples. So they will take a lot of time to recover in my view. While stock prices may not correct much, but the underlying earnings will take some time to recover because the volumes have not seen a recovery. Rural is still going through a period of lull. And not just staples, I think even within consumer discretionary, some of the lower ticket mass items are struggling, while jewelry, hotels, things like Trent and all, they're doing phenomenally well. But it's a very K-shaped. I mean, it's a very over-abused term, I know, but that's the underlying reality, that there are two different sets of consumers out there in the economy, one which is struggling and other which is flourishing.
Correct. No, that's. I mean, you're right. K-shaped is overused, but it is what we're seeing. Another important or interesting factor that caught my eye in your report, Gautam, is your earnings upgrade downgrade ratio of 0.6 times, which you say is the worst since Q3 FY22. And let me just break that down. So 58 companies saw upgrades by more than 3%, and 84 companies were downgraded by more than 3%. Now, even in that rubric and that overview that you've given, that Q3 was largely a good quarter, how do you see this factor?
So this is clear reflection of the weakening of earnings trend in some of the broader market segments. While when you look at Nifty, you don't get this picture because Nifty earnings are quite stable. We are still talking about 20% growth. Forward earnings revision is quite stable. But in the broader markets, non-Nifty coverage universe that we track, there have been some disappointments, which is also what is reflected in the forward market revisions, forward earnings revision in this segment of the stocks. So this the earnings upgrade to downgrade ratio being weakest in 3Q FY22, is clearly a reflection of that fact. Also, you need to remember, Tamanna, now that we are entering FY25, it will be lapping up on a high base of margins. Do remember FY23, our margins had collapsed because commodity costs had spiraled up post Russia-Ukraine. We had posted a decadal low gross and EBITDA margins in FY23. Now, FY24 has been a phoenix-like recovery in margins from those absolute bottom lows. And thus, FY25, the job becomes that more difficult, which is what some element of reality is sinking in some of the mid and small cap stocks, where we have seen a very weak kind of earnings revision on a forward basis.